The 6% reality. Nvidia is currently the only thing preventing the Magnificent Seven from reporting an earnings growth rate lower than the average S&P 500 utility company. In Q1 2026, these seven giants posted a combined earnings growth of 22.8%, but when you strip out Nvidia, that number collapses to just 6.4%. The market is pricing in a broad AI revolution, but the financial statements suggest we are looking at a one-company stimulus package. This massive performance gap reveals a critical failure in the promised AI trickle-down effect. The real story isn't the growth of the sector, but the extreme concentration of profit in a single hardware vendor, while the other six struggle to find their footing. This structural imbalance is a massive red flag for the Capex Wealth Transfer. The Capex Wealth Transfer. The other six titans are currently locked in a capital expenditure arms race that looks more like a tax than a growth strategy. Microsoft, Alphabet, and Meta increased their infrastructure spending by 30% this quarter, primarily funneling cash directly into Nvidia's pockets. On paper, they are building the future, but on the income statement, they are trading high-margin software revenue for capital-intensive hardware builds. We are seeing a massive transfer of wealth from the world's most established software ecosystems to a single chip designer, with no clear timeline for when this infrastructure starts paying for itself. This spending spree is masking a significant deceleration in core advertising and subscription businesses. If the revenue doesn't materialize soon, this infrastructure will become a massive drag on their enterprise utility. The enterprise utility bottleneck. Enterprise AI adoption is failing the P&L test. While Nvidia sells the hardware shovels, the miners are still looking for gold. Most Fortune 500 companies report that AI pilots are stuck in testing because the per-seat cost exceeds the productivity gain. This is a utility bottleneck that the vision statements conveniently ignore, and this disconnect is most visible in the stalling growth of the cloud infrastructure giants. Circular cloud accounting. Azure and AWS are reporting 20% growth, but that number is heavily subsidized by their own internal AI projects and sweetheart deals with startups they have funded. When you audit the organic demand from non-tech industries, the growth curve is surprisingly shallow. These cloud providers are effectively their own best customers, using their balance sheets to prop up consumption metrics. This circular economy can only last as long as the investor patience for high capital intensity holds. The moment the market demands actual free cash flow from these AI investments, the cloud narrative will undergo a massive structural correction. And that correction will finally reveal the real signal under the noise. The signal under the noise. The reality of Q1 2026 is that the Magnificent Seven label has become a statistical mask for a Mag 1 market. This concentration of earnings power in a single hardware vendor suggests that the AI trade has entered a dangerous decoupling phase where infrastructure spend is detached from enterprise utility. As we saw in the Capex Wealth Transfer and the enterprise utility bottleneck, the six buyers are currently subsidizing Nvidia's margins at the expense of their own. This suggests that the real risk isn't a lack of chips, but a lack of profitable use cases for them. For operators and investors, the strategy must shift from tracking GPU benchmarks to tracking software margin expansion. If the buyers cannot monetize the intelligence they are building, they will eventually stop buying the hardware. This would turn Nvidia's backlogs into inventory write-downs almost overnight. Watch the capital expenditure guidance in the upcoming Q3 filings for Microsoft and Meta. Any downward revision in their chip orders is the concrete indicator that the Mag 1 illusion is finally breaking. Subscribe for more